I just want to welcome you again to our Fall Ag Policy webinar series. You're probably looking at the screen and seeing Wisconsin Ag Law Update and saying, I didn't think that was what I signed up for. So one of the programs that I host regularly is the Wisconsin Ag Law Update. It is a 2 to 3 time a year webinar where I talk about changes in state and federal legislation, regulation, and case law. And when Silva, Dr. Hadachek, and Dr. Mitchell came up with the policy webinar and asked if I would participate, I thought, what better opportunity than to merge our two webinar series? So today's program is going to be a special tax edition, focusing on the changes in what's been called OBBBA, OB3, One Big Beautiful Bill Act, and what we'll learn later actually has a slightly different name. But essentially looking at the tax changes that have come up in the last 6 months to a year. Like Silva said, my name is Kelly Wilfert. I work for UW-Madison Division of Extension as a farm law outreach specialist. I am also actually an attorney, so I do always start off with a quick disclaimer that today's presentation is for educational purposes only. It's only going to provide general information and a general understanding of the law, not specific legal advice. So you should always consult with your accountant or your attorney about your specific situation and how these changes will apply to you. Keep in mind that we do not have an attorney-client relationship, and again, you should get advice from a licensed professional in your state. With that said, those of you who have joined me for the Wisconsin Ag Law Update previously are probably used to seeing this screen. We've got a little bit of a timer on the right-hand side and a whole list of topics that we go through. We are tossing that out the window for today. Today's focus is going to be strictly on farm tax updates from the One Big Beautiful Bill Act. Future ag law updates will likely go back to our intense format where we cover a lot of topics in an hour, but today we're really going to hone in on tax. So what are some of our farm tax impacts from the One Big Beautiful Bill Act? Before we actually dive into those tax changes, I want to take a step back and slow down and think about how did we get here? So tax does change somewhat regularly, as we've seen in the last decade. Often we're seeing those changes, though, coming from case law. In this instance, we are actually seeing tax changes come in a full package format from legislation coming out of Congress. So how did we actually get there? A lot of these changes came out through the federal budget process. And when you think about the federal budget process, I want you to think about three big steps to this budget process. The first thing that Congress is going to attempt to do, and I should note, theoretically, these are annual processes. They haven't been as successful in the last decade or so as actually accomplishing all steps in every single year. But in theory, these are an annual process. So the first thing that's going to happen is a budget resolution. Congress is going to essentially create target revenue and spending goals. Now, these are not going to be topic specific. Rather, there are about 12 big topics. So you can see some of them, defense, agriculture, Social Security. Congress is at this point just trying to say, how much money are we going to put in each bucket? That happens in our budget resolution. Once they reach an agreement, once they finalize that budget resolution, we move into budget reconciliation, which is when Congress is finally starting to make changes to the laws to actually achieve the target revenue and spending goals that they set in that budget resolution. So what we're going to be talking about today, what's commonly known as the One Big Beautiful Bill Act, that was the reconciliation bill, or the act that came out of that bill, which actually started making changes to the law to try to meet that budget resolution. Now, the One Big Beautiful Bill Act was actually signed into law on July 4th. And so some folks may be thinking, why did we go through then this recent government shutdown if we had a budget resolution. We had our big category set. We made our changes to the law. So why in the world on September 30th, or I should say on October 1st, did we shut down? There's one third, or I shouldn't say there's one third, there is a third step to this process called appropriations. So first Congress sets these bucket levels, they set their budget. Then they use reconciliation to figure out how are we actually going to achieve those numbers. And then the appropriations bills are actually how Congress authorizes its federal agencies to spend. There are typically 12 appropriation bills. They can be addressed individually or in an omnibus, so a collective package to move it forward. What happened this year was we got hung up in appropriations. And so although reconciliation had been passed, these other bills were what was getting caught. So, and I apologize, I talked through that. You can sort of see here, fiscal year 2025 ran from October 1, 2024 to September 30th, 2025. Fiscal year 26 then picked up October 1, 2025, and will run through September 30th, 2026. In March, we saw that full year Continuing Appropriations Act and a continuing resolution that kept the government funded through September 30th, buying Congress some time to work on their fiscal year 26 budget. April, we saw that concurrent resolution for the budget spending levels come through. And July 4th was when we saw the finalization of OBBBA, that omnibus reconciliation bill, which was implementing those major tax, spending, and policy changes. So essentially, we had our budget structured, but the agencies still didn't have the authorization to spend, which is why we ran into the government shutdown. Where are we now? If we go back about 2 weeks ago, Congress passed a new continuing resolution to maintain those funding levels from last year and fund the government through January 30th, 2026. They also did knock out 3 full-year appropriations bills within that piece of legislation. Agriculture was a part of that, and that did include extending the 2018 Farm Bill to September 30th, 2026. So we've got a lot of moving parts and pieces here. This was, I will say, a really important piece for farm policy that we got this extension of the Farm Bill. If we go pre-November 12th, a lot of the conversation in the farm policy world was about the fact that we would need a skinny farm bill to be passed so that we didn't have permanent law take effect in January. Because the continuing resolution also included an extension of that 2018 Farm Bill, we've again bought ourselves a little time. Keep in mind, though, this is an ongoing extension, right? This is year 3 of that extension of the 2018 Farm Bill. We're balancing that, though, with the reconciliation bill that did make some significant changes, as you heard Silva and Professor Mitchell talk about last week. So again, there's been a lot of moving parts and pieces. What we're going to focus on today, though, is specifically tax. So where we're generating revenue from and what you might feel like is most impactful on your farm, thinking about what is that bill that I'm going to owe to the federal government at the end of each year. So again, the tax piece of this came out of the reconciliation bill. We're not done yet with government funding, but we are for today. We'll have those ongoing conversations in the national space. But for today, again, we're going to focus on farm tax impacts from that One Big Beautiful Bill Act. Now, I told you earlier, I'm going to actually give you a different name for this. The real name of OBBBA, or the One Big Beautiful Bill Act, is actually Public Law number 119-21. The Byrd Rule, which is a parliamentary rule in the US Senate, actually removes the name One Big Beautiful Bill Act. So this is a procedural rule that says that reconciliation bills only can focus on fiscal issues and all unrelated provisions should be struck unless they can get, I believe it's 60 votes to keep it. So things like the title that was originally drafted, the One Big Beautiful Bill Act, that actually got knocked out. You're still going to hear folks refer to it as that. So you might hear it as Reconciliation Bill, One Big Beautiful Bill Act, OBBBA, OB3, these are all referring to the same law. I will say, bear with me today, I might call it by a few different names too. OBBBA kind of rolls off the tongue. So most likely that's what you'll hear me say. But just know that if I use any one of those names, we're still referring to that same piece of legislation. Okay. So let's talk a little bit about a different piece of legislation that was really a driving factor to OBBBA, and that is the Tax Cuts and Jobs Act, which was proposed in 2017 or signed in 2017 and then actually became effective in 2018. The Tax Cuts and Jobs Act also made quite a few changes to our tax code as we knew it. But there were a number of expiring provisions. So I've just got them noted here. We had some reduced income tax rates and increased standard deductions. Those were scheduled to go away at the end of this year, 2025, and revert back in 2026 to what we had seen back in 2017. Some of the child tax credit expansions were going away, alternative minimum tax, 20% deduction for qualified business income or QBI. Bonus depreciation had begun to phase out and was set to fully phase out by 2026. And there were supposed to be some changes in the unified estate and gift tax credit. Again, all of these were changes that were made with a sunset. So they were expiring and going back to the 2017 language. What we are going to see today is that OBBBA addressed a lot of these items and it maintained these changes for the next several years. Some of them permanently, some of them for a set period of time, added some new items, again, some of which are permanent, some of which are temporary. So we're going to explore that today. I'd like to break this down and think about it in a couple of buckets as we talk about it. So the first thing I'm going to end up talking about is the estate and gift tax exemption. Then we're going to dive into topics that are more income tax based. So our tax brackets and our standard deductions, our personal deductions, some business topics, some hot topics around deductions for tips and overtime income, and of course, childcare. You know, one thing that we hear here in Wisconsin is that childcare remains a challenge both financially and just in availability. And so we'll talk a little bit about what are some of these tax changes that perhaps are striving to impact that. All right, the very first thing we're going to dive into is the estate and gift tax exemption. If you're involved in agriculture, I imagine you've probably heard about farm succession and this ongoing challenge about how we're going to transfer farms from one generation to the next. And a topic of concern that often comes up is the estate tax. The change that was made in OBBBA was that in 2026, the estate and gift tax exemption is going to increase to $15 million per person. If you're looking back at 2025 here, we're seeing that it was that $13.99 million per person. And you might be saying, so why is this such a big topic? What does this mean? How does it work? If you look at the list of dates here, you'll see that the estate and gift tax exemption has been around for quite a while. And it was around before this 1997 date, just only had space to go back so far. But this number changes pretty regularly. If we look from 2018 till 2025, you're going to see that we started at 11.2 million and adjusted upwards. We've now gained almost $3 million per person from where we were at, a fairly significant gain. But if we go back to 2017 and even back to 2010, we start to see we were at a $5 million number. So about half of where we were at in the last few years. And realistically, if we compare 5 million in 2010 to our 2025 number of 13.99, we're almost closer to a third. So that was really a big topic for farm succession. If we go back to 2010, or especially back to the early 2000s at $1 million of exemption, estate tax was a major issue. We're starting to see that change a little bit as these numbers get bigger. I'm talking in very theoretical terms. So let's actually take a step back and talk about what is the estate and gift tax exemption? What is the estate tax? So the first thing I want you to know is that Wisconsin does not have a state level estate tax, which means we are only looking at federal estate tax. And the federal estate tax ranges from 18% to 40%. Much like the income tax, it's on a graduated scale. But certainly when we start looking at 40%, that can be a scary looking number. This is where the unified estate and gift tax credit comes in. And I should say exemption. I use those a little bit interchangeably with this particular one. It is called a credit. It's not a refundable credit. So just keep that in mind. But that credit is going to be set to $15 million per person in 2026. What that means is that if you pass away in 2026, you can pass up to $15 million to whomever you would like, either at the time of your death or during your lifetime. We're going to look at a collective number without any estate tax being due. Now, each of us can pass $15 million. So if you are married, you can pass $15 million if you pass away in 2026, and your spouse can also pass $15 million if they pass away in 2026. So a collective $30 million, and I say dollars, it can be assets equal to that value without any estate tax being due. So that means that you and your spouse are not paying any estate tax. And of course, as a reminder, our recipients or our heirs are not taxed either. So those are some pretty significant numbers. On top of that, each of us also has an annual gift exemption. So the way that the annual gift exemption works, in 2025 and 2026, that number is set at $19,000. So you can give $19,000 or $19,000 worth of assets away in each year to each recipient with no tax consequences. So I could give Silva $19,000, no tax consequences for me or for him. I could give Jeff $19,000. Again, no tax consequences for either of us. I could give Paul $19,000, no tax consequences for either of us. As soon as we cross that annual exemption, I give Paul $19,001. Now that $1 counts against my lifetime exemption, and it reduces my $15 million down to 15 million minus 1, right? So these are significant numbers. Let's just take a peek back again. If we're looking at the late 90s, the early 2000s, when we were $1 million or less, this was a big issue for our farms because we simply had a larger number of farms who were over that exemption. Today, these numbers are quite a bit higher. And so even though our farms have appreciated, it's not quite as big of a challenge for some of our farms. And I'm going to jump ahead here because I know I have, maybe I do not. Okay, sorry about that. Just got it tucked in my notes here. What I wanted to share with you is that USDA's Economic Research Service actually has evaluated these numbers to say how many farms actually are impacted by estate tax. And a February 2024 report that they did estimated that there are about 41,104 estates that result from principal operator deaths in a given year. Out of all of those, at a $13.95 million exemption, they anticipated that about 0.3% or 141 farm estates would be required to file an estate tax return and would owe estate tax. So certainly for those folks who are impacted, this is a big deal. But we do have a little bit of wiggle room for quite a few of our operators today. If you're looking at this and feeling like this is Greek, here is the way that I like to think about this. An easy way to estimate, do I have an estate tax problem, is to ask yourself, what is my net worth? So my net worth is about blank. Insert your number there, check your balance sheet, and fill in the blank. That is more than, less than, or close to $15 million or $30 million if you're married. Because again, remember, you and a spouse together can combine your estate tax exemptions to pass a little bit more. If you are more than or close to, well, then we probably have an estate tax issue we want to keep an eye on and do some planning. If we are less than $15 million, estate tax probably isn't going to be that driving factor for your estate planning, right? Because we're not at that number. Keep in mind, though, this does not address intestacy. So the idea of who gets what. So if you haven't decided how your estate will be distributed, state law actually steps in and does that. We, of course, also have to think about probate and the associated costs there and long-term care. Plans are probably going to be more likely to focus on addressing these challenges, timing and income tax planning over the next couple of years than necessarily focusing on estate tax tools. Because again, estate tax is just not as likely to be a driving factor in estate planning for many Americans or many farmers. As I've been talking about the exemption, I've been talking about this idea that if you are married, you and your spouse each are going to have that $15 million exemption. One thing that the federal government shared with us, the IRS helped us out a little bit, gave us some information about that concept called portability, was when do we have to make that election? Now, when someone passes away, they may not be required to file an estate tax return. However, the way to elect portability to be able to use the full unused spousal exclusion is to file an estate tax return and elect that concept. We had some confusion when this first arose as an option about folks not knowing that they had to file that return and make an election. And so a lot of folks started attempting to make that election perhaps a couple years after that individual had died. The IRS did clarify for us in this RevProc that an extension request can be made on or before the 5th anniversary of the decedent's death. So if you have someone in your family, a spouse who has passed away recently in the last 5 years, and you are looking at a potential estate tax issue and have not elected portability, there may still be time. We want to keep that 5-year anniversary in mind in order to take full advantage of these estate tax exemptions. Okay, I'm going to pause for just a second because I know that this is a big topic. Are there any questions? I'm not seeing any in here about estate tax exemption. Feel free, again, put those in the chat or the Q&A as they come up, and I will happily circle back to them later. But since there aren't any questions on estate tax in here right now, I'm going to move on to some of the income tax changes that we saw from OBBBA. So the first one we'll talk about is going to be the tax brackets and standard deductions. Now, I hope everyone on here knows that we do have slightly different brackets and deductions depending on whether we are filing single, married filing jointly, married filing separately, head of household, and a few other classifications. It's not super easy to get all of these onto one slide. So what we're going to look at today are married filing jointly, just so that you can see some of the changes which are being made. So as I mentioned earlier, the tax brackets and the standard deduction had been set to revert to a lower bracket and a lower standard deduction in 2025, which alone, assuming we didn't make any other tax changes, right, or any other income changes, would have resulted in an individual paying more tax. The new law, I'll say, continued these lowered tax brackets and this higher standard deduction and made them permanent for the years moving forward. So what does that look like? I have here 2024's brackets for married filing jointly and 2026 married filing jointly. 2024 is going to be the last year that you filed since we're not through 2025 yet. So just for comparison, we're going to look at 2024 and again with 2026. where we're headed next year. 2025 is going to be in the middle here as well with those standard inflation adjustments. But again, just because you haven't filed those yet, we're going to compare to 2024. So again, on the slide here, you can see our tax rates stayed the same. If we look at the column on the far right, you can see that some of the brackets increased slightly. So we're keeping a little bit more income at a lower rate. And on the bottom, you can see we had a little bit higher standard deduction coming up in 2026. So how does this actually work in practice? Quick example. Let's say that we have an adjusted gross income of $40,000 married filing jointly. And if you're thinking, "Ooh, I don't know about that number, Kelly," what I was trying to do is stay within one tax bracket so we're not calculating a number of them. So let's look at this. If we had an AGI of $40,000, we take out our $29,200 standard deduction, we still have about $10,800 of taxable income. That still fell into, $10,800. We're still going to fall into our 10% tax bracket here. Multiply that by 10%, we're paying about $1,080 in tax. And I see I've got a typo here. This should be 2026 comparatively. Here, because we have this higher standard deduction of $31,500, we've only got $8,500 of taxable income, still going to be at that 10% rate and only be paying $850. So same dollar amount of income, but changing that standard deduction ultimately results in a little less paid in tax. And similarly, if we had looked at using a larger income number with more brackets, what we would have seen is that, again, more income is being taxed at a lower level rather than a higher level, resulting in an effective rate that is lower. Oh, but there have been a few other changes. We know that our changes were not just our brackets and our standard deductions. So what are a few of those other deductions that have changed? The first one I'm going to talk about is the state and local tax deduction, commonly known as SALT. The SALT deduction is available to filers who itemize. So instead of taking the standard deduction, you're itemizing. And this allows you to take state income taxes, property taxes, and sales taxes and deduct them. The Tax Cuts and Jobs Act set the limit for that deduction at $10,000. However, OBBBA increased this quite a bit. So actually effective this year in 2025, OBBBA has said that our SALT deduction will go up to $40,000 as a limit. And in 2026, it'll jump up to $40,400. These continue to increase by a set factor through 2029. But as we mentioned, not all of these changes are permanent. So under OBBBA in 2030, the SALT deduction is going to revert back down to that $10,000 adjusted for inflation. So we've got some opportunities to perhaps take advantage of the SALT deduction if it makes sense for you in the upcoming 4, 5, 6 years here. But know that in 2030, it is set to drop back down to $10,000. And again, it's only available to folks who are itemizing. So typically, we're not going to see folks take advantage of this unless all of their itemized deductions are higher than that standard deduction that we looked at. Another change that you may have heard about is the personal car loan interest deduction, which is a brand new deduction for qualified passenger vehicle loan interest for tax years 2025 to 2028. You are not required to itemize to take advantage of this particular interest deduction, which is different, of course, from our mortgage interest deductions that you may have seen previously. This deduction is allowed for interest paid or accrued during the taxable year on debt that was incurred after December 31, 2024 and is secured by a first lien. The deduction is capped at $10,000. It phases out when modified adjusted gross income exceeds $100,000 for folks who are filing as single or $250,000 for folks who are married filing jointly. There are some conditions around what vehicles and what loans do actually qualify for this. So as you saw, the debt had to have been incurred, meaning I first got the loan after December 31st, 2024. So if you bought it December 30th of 2024 last year, you're not going to be eligible for this. But if you bought something here in 2025, let's take a look and see what else is required to qualify. So an applicable passenger vehicle must be new. So used vehicles and loans on used vehicles do not qualify. Has to be something that's manufactured for use primarily on public streets, roads, and highways. So arguably some of our I shouldn't say some, none of our implements of husbandry are going to qualify. It's got to have at least 2 wheels, and it has to be a car, a minivan, a van, a sport utility vehicle, a pickup truck, or a motorcycle. And final assembly of the vehicle must occur in the United States. So there are quite a few conditions to this personal car loan interest deduction, but again, certainly a new opportunity for the next couple of years if it is something that applies to you. The last item that we will talk about under sort of the personal deductions are going to be our charitable deduction changes. So these changes are effective for tax years beginning after December 31, 2025. So what that means is in your next filing coming up here, we're not going to be using these rules. We're still using the old charitable deduction rules. When we move forward to 2026's filing, which will occur in 2027, that's when we're going to start seeing this set of changes. So for charitable deductions, OBBBA made it so that non-itemizers, so folks who are just taking the standard deduction, do have the opportunity to make use of a charitable deduction limited to $1,000 for folks who are filing single and $2,000 for folks who are married filing jointly. Historically, this was only available to folks who were itemizing. And what you'll see is for those who itemize, we have a new 0.5% floor. So an individual may only take a deduction for contributions that exceed 0.5% of their contribution base, which is typically their adjusted gross income. So a little bit of a change there. In addition, there were also some changes to charitable contributions by corporations, which are allowed to the extent that the aggregate contributions, so all of our charitable contributions for the year, are more than 1% of taxable income, but less than 10% of taxable income. So again, a few changes there. Keep in mind, they're not going to be in effect for your current filing, but what we're looking ahead to for tax year 2026 and the future. The Act also makes permanent the individual contribution limit of 60% of your contribution base, again, typically your adjusted gross income, for cash gifts to public charities. Whew, okay. Let's jump forward and start talking about income tax and income that may or may not qualify for some new deductions. So I've titled this employment and off-farm income because these are where we're most likely to see these two particular provisions crop up or have folks hope that they might crop up. So specifically, I'm going to talk about the deductions for qualified tips, and then we'll talk about the deduction for qualified overtime. Qualified tips under OBBBA, this deduction for qualified tips is a new deduction under OBBBA. OBBBA defines these qualified tips as any cash tip received by an individual in an occupation that traditionally and customarily received tips on or before December 31st, 2024. Now, if you're looking at your neighbor who's watching this with you and kind of elbowing them going, oh yeah, we used to tip each other, right? I've got maybe some bad news. The Department of Treasury has released a list of occupations that have been deemed to have customarily received tips on or before December 31, 2024. So as much as we might be interested, or folks might be interested in trying to get creative with this, there is a pretty detailed list about what are tipped occupations that are going to qualify. So things like wait staff, bartenders, hotel staff, ushers, home maintenance workers, photographers, event planners, babysitters, tutors, massage artists, hairdressers, tattoo artists, tour guides. So it is a pretty significant list. I did not see farmer on that list though. So there were not, other than perhaps landscaper, we could probably argue is agricultural in nature. We didn't see a lot of agriculture listed on that list. However, if you have off-farm income in one of those areas, perhaps you are a bartender on the side, this deduction is a temporary federal income tax deduction for up to $25,000 for years 2025 to 2028. So this will be something applicable in this tax year, 2025. However, after 2028, we will see this go away again unless it comes back in legislation, making it permanent. Our deduction for qualified overtime income is also going to be a temporary deduction for years 2025 to 2028. So again, theoretically, it will go away after 2028. Again, this one is probably not going to be super helpful for those of us here in agriculture. This is a $12,500 limit deduction limit for folks who are filing single, $25,000 for those who are married filing jointly. However, qualified overtime compensation is defined in the Act as overtime pay that is required under the Fair Labor Standards Act. And as you may know, agriculture is often exempt from overtime pay. So the Fair Labor Standards Act does exempt any employee employed in agriculture from overtime pay. And they define agriculture to include farming in all of its branches, and among other things, includes the cultivation and tillage of the soil, dairying, the production, cultivation, growing, and harvesting of any agricultural or horticultural commodities, the raising of livestock, bees, fur-bearing animals, or poultry, and then any practices performed by a farmer or on a farm as incident to or in conjunction with farming operations. So things like preparing for a farmer's market, delivering to storage or to market, or to carriers for transportation. The Fair Labor Standards Act also exempts secondary agriculture labor, which is sort of a catch-all, that it's all practices performed by a farmer or on a farm as incident to or in conjunction with farming. So agriculture does not include employment outside of that scope of what they consider primary or secondary agriculture. Again, those could be things like packing or processing your own produce, which would be considered incident to or conjunction with, again, depending on how exactly that's set up. But something like packing and processing other farms' produce would not necessarily qualify for an agriculture exemption, which would then proceed to possibly qualify for overtime. One thing to note that we're hearing from a lot of labor practitioners in this space is that if an employee performs 1 hour of non-agriculture work in a week, all hours exceeding 40 do become subject to overtime pay for the week, even if the rest of the overtime was agriculture work. So there are some potential workarounds for folks who may be voluntarily paying overtime and are trying to coordinate an individual's activities or job description so that that overtime becomes required under the Fair Labor Standards Act. But for those of us who are perhaps not getting creative, not getting that little bit of extra advice, if we are just an employee employed in agriculture, we are FLSA exempt, which means there is no taking advantage of that qualified overtime compensation deduction. So if that's something that applies to you, certainly get advice from a qualified professional who represents you if you are trying to consider paying overtime and also trying to make sure that that employee can take advantage of that deduction. A little bit tricky there. Okay, let's move into topics that are a bit more typical for our income tax for farm and business. Earlier, we mentioned that the qualified business income deduction was set to phase out. Instead, this 20% qualified business income deduction for sole proprietors and pass-through businesses became permanent under OBBBA. So you might know this as 199A. This also includes the 199AG deduction for agricultural co-ops and their patrons. And there was also added a new minimum $400 deduction for taxpayers with at least $1,000 in active qualified business income. To qualify for that minimum deduction, though, the taxpayer does have to materially participate. These changes are going to be effective in 2026. So again, you're not going to see a change from what was already planned for 2025, but we're going to be looking 2 tax filings ahead for when this will kick in. We also saw Section 179 expense enhancements increased. So the maximum 179 deduction for 2025 was scheduled to be $1.25 million with an investment limit of $3.13 million. But OBBBA increased that deduction to $2.5 million with an investment limit of $4 million for property placed in service for taxable years beginning after 2024. So this is a change that we are going to see during this current filing season. 179 has always, I shouldn't say always, but previously been indexed for inflation and is going to continue to be. So we will continue to see these numbers change. Now, if you are familiar with 179 expensing, you're probably familiar as well with bonus depreciation. The Tax Cuts and Jobs Act was also phasing out bonus depreciation. They had started off with 100% bonus depreciation through 2022 for qualifying property acquired and placed into service after September 27th of 2017. But that was being phased out over the next 4 years and was scheduled to completely end in 2027. However, OBBBA brought back bonus depreciation and made it permanent at 100% of basis for property acquired after January 19th of 2025, which includes trees and vines planted or grafted after January 19th, 2025. Taxpayers can also elect to have the 40% bonus depreciation that would have applied in this year apply rather than the full 100%. So certainly contact your tax preparer and make sure you're making a decision that makes sense for you. We also are seeing a new 100% depreciation deduction for qualified production property. So like I said, this is a new elective 100% depreciation allowance for qualified production property, which are going to be portions of non-residential real property that meet a variety of requirements. I'm going to skip those for just a moment to jump down and talk about qualified production activity. So our qualified production property has to be used by the taxpayer as part of qualified production activity, which does include manufacturing, production, or refining of tangible personal property. Production is key here in agriculture, right? And specifically, production here is limited to agricultural production and chemical production. So agriculture we see here can potentially qualify, but what we want to keep in mind, jumping back up to that list of requirements, is for this property to qualify, it's going to have to be subject to depreciation under Section 168. It has to be here in the US, again, being used as an integral part of that qualified production activity. The original use has to begin with the taxpayer. So this is going to be something new, right? It's not going to be a building that was being used by someone else and we've purchased it, because the original use has to begin with our taxpayer. So a few things going on here. Construction on that has to begin after January 19th of 2025 and before January 1st of 2029, and placed into service after the date of enactment and before January 1st, 2031. So what we are seeing here is that we have another temporary opportunity, but there are quite a few restrictions around how we might be able to use that. We had the business interest deduction limit. We have seen some changes here as well. So the Tax Cuts and Jobs Act limited our business interest deductions generally to 30% of adjusted taxable income beginning in 2018. Until 2022, taxpayers could add back their depreciation, amortization, and depletion to their adjusted taxable income, which actually increased the amount of their allowable business interest deduction. However, beginning in 2022, adjusted taxable income was still reduced by depreciation, amortization, and depletion deductions. So we didn't add those back, which resulted in some lowered business interest deductions. OBBBA permanently restored the provision for computing adjusted taxable income. So we are back to adding back those deductions for depreciation, amortization, and depletion. And that is going to kick in here for 2025. So that'll be for this filing season, if that is something that you are taking advantage of. There also were some changes for research and experimental expenses. Beginning in 2022, these were not deductible and were required to be amortized. This came out of the Tax Cuts and Jobs Act, but it had a delayed effective date until 2022. OBBBA went ahead and permanently restored that deduction for domestic research and experimental expenses paid or incurred in taxable years beginning after December 31, 2024. So again, a change that is relevant for our current tax year of 2025. If we have research that's going on outside of the country, that does still have to be amortized over 15 years. Another change that we have is our limit on the business meal deduction. So the 50% deduction for meals provided for the convenience of the employer is scheduled to end at the end of 2025, and that has not changed. OBBBA did provide an exception for certain meals provided on certain fishing boats and at certain fish processing facilities. So if that applies to you, certainly feel free to look into that. But in general, we are seeing this deduction go away. We've seen some changes in 1099 requirements as well, specifically with a 1099-K, which were our third parties who were required to report transactions. This is going to be a change where those third parties are not required to report unless that aggregate transactions exceed $20,000 and the aggregate number of transactions exceeds 200. What I'm seeing more farms be interested in is related to the 1099 MISC or 1099 NEC. So current law requires those folks that are engaged in trade or business to file an information return if they're making payments to any person totaling $600 or more over the course of trade or business. So if folks are paying rent, for example, you may be used to having to send that 1099 if your rental payments are over $600. But OBBBA did increase this payment threshold to $2,000. So again, depending on rental rate, amount of land, we might see some changes there in folks who are sending or receiving our 1099s. And this is beginning with payments made in 2026. So as we're approaching year end here, for example, and I'm just going to stick with the rent example, if rent is being paid typically in January, and so the next payment is going to be in January 2026, you may be still sending that 1099 if you are over $600 for tax year 2025, because that check got sent all the way back in January of 2025 during this taxable year. But perhaps next year, if you are between 600 and 2,000, perhaps you now do not have to send that 1099 for the 2026 tax year because, again, you're not over that $2,000 requirement. But you certainly have to know where you are at as far as how much are you sending to each payee, because if you're at 2001, we need to be sending that 1099. A couple of other interesting things going on in OBBBA, the exclusion of interest on certain ag loans. This is actually going to be an exclusion that financial institutions, so our banks, are going to be taking advantage of. It's not something that a farmer is going to be taking advantage of. But what this does is it's allowing certain financial institutions to exclude 25% of interest income derived from loans if those loans are secured by real property, so real estate, that is substantially used to produce agricultural products. And you can see there are a few others for fishing, seafood processing, aquaculture. But here in Wisconsin, we primarily are expecting to see this with financial institutions who have loans that are secured by a mortgage on farm real estate or ag land. This is going to be effective for taxable years ending after July 4th, 2025. Certainly it is an advantage to those financial institutions. I've had some conversations with colleagues about, do we think that that would allow a farmer to try to negotiate on interest rate? Maybe, maybe not. But certainly of interest to see that there's an incentive here to have your loan be secured by agricultural property. I was reading through through that literature, through those statutes earlier today, and did note that there are some restrictions on the size of the loan relative to the value of that property. So for example, I can't go out and get a loan on a $40 million apartment building and throw 40 acres of land on as collateral and take advantage of that deduction for the whole loan. It would be restricted to that value of the agricultural property. So certainly going to be interesting to see how that gets used by some of our banks and financial institutions. Something that is perhaps more relevant to our farmers or our farmland owners was a change in the gain from the sale or exchange of farmland property to qualified farmers. So this is a new election that would allow the seller to elect to pay their taxes on the gain in 4 equal installments. So rather than paying everything in year 1, they could spread this out over 4 years. It's important to note this does not change the tax calculation. So a very common question is whether spreading out and making this election changes the years in which the income hits your tax return, and it does not. All it is doing is spreading out and creating a payment plan. That calculation is still being done in year 1. Folks who are looking to take advantage of this, they do have to sell that farmland property to a qualified farmer, which would be someone who's going to be using that for farming purposes. They are agreeing then that that property will be restricted to prohibit use of that property for anything other than as a farm for 10 years after the date of the sale or exchange. In addition, if you're looking to take advantage of this, the seller is only able to take advantage if they are an individual, trust, or entity that has either farmed the property themselves or leased it to a qualified farmer for 10 years prior to the sale. So we have to have the land be in agriculture, be in farming for 10 years leading up to the sale, enforce that it's only going to be used for farming for 10 years after the sale, and all that you're getting out of that is the ability to pay it over 4 years. It's not changing the calculation. This provision is going to be effective for sales or exchanges occurring in tax years beginning after July 4th of 2025. And one last section that I'm going to go through, I know we're getting close to 1 o'clock here, but again, we recognize that childcare continues to be a challenge in rural Wisconsin, both on financial accessibility as well as just availability. And OBBBA did make some changes as far as the child tax credit and some childcare credits, so we will just run through those quickly. First one is that child tax credit. They permanently enhanced that child tax credit of $2,200 or to be $2,200 beginning in 2025 for qualifying children under the age of 17. It's going to be adjusted for inflation thereafter, retained some higher income phase out thresholds, made it permanent that there would be a $1,400 refundable portion of that credit indexed for inflation, and the $2,500 earned income requirement in order to receive that. There also were some changes to the credit for other dependents. So for folks who don't qualify for that child tax credit, it made permanent the $500 non-refundable credit for those folks. OBBBA also created the Trump accounts, which were a new type of tax-preferred savings account for children established as IRAs. They're not Roth IRAs. There's no tax deduction for contributions either. But it can be used as a tax-preferred savings account. Has to be established before the child turns 18. Child has to have a social security number, $5,000 contribution limit indexed for inflation, and contributions are going to be allowed until the year the beneficiary turns 18, but no contributions can be made until 12 months after July 4th, 2025. So we are not necessarily going to start seeing these until July 4th of 2026. In addition, OBBBA created a pilot program where the Secretary of Treasury is going to contribute $1,000 into an eligible account for each qualifying child born from 2025 to 2028. If a Trump account has not been established for a child when a parent files a tax return, the IRS is going to create that account and notify the taxpayer who is responsible. The account can be declined if that's something that folks are interested in doing, and just note that traditional non-Roth IRA distributions will apply. We also saw some enhanced employer-provided child care credit, adoption credit, dependent care assistance program, child and dependent care credit, all some changes happening there. But as we're hitting the last minute or so of our time together, if tax is something that's of interest to you, I want to talk about where can you continue learning. Couple of options. We do have some resources on our farm management program site as far as income tax considerations, but two other extension groups that are really working hard on this topic right now are Penn State Extension and Iowa State Center for Agricultural Law and Taxation. Both of these folks have great resources. The Center for Ag Law and Taxation has a lot of written material. Penn State is going to be hosting a variety of programs coming up. Farm taxes, basic filing requirements, how your tax is calculated, how business entities are taxed. And so certainly if those are of interest, federal tax is going to be similar across the country, so don't hesitate to take advantage of those resources as well. Silva did already update you with our upcoming ag policy webinar schedule. Please continue to join us over the next few weeks to talk about what else is happening in farm policy right now. If you were super interested in the farm succession and the estate tax topic we were talking about, consider joining us for Cultivating Your Farm's Future in February of 2026. That program is going to take place on Thursday nights. And is going to help your family or farm start talking through farm succession. In addition, if you would be excited to get back to our regular Ag Law update in the future, you can always reach out to join our email list to learn when those will be, or go take a peek at past Ag Law updates at go.wisc.edu/extension Ag Law or EXT Ag Law update. Okay. Thank you all for hanging out with us. I see Silva did start the poll, and I hope you were able to learn a few things from our time together. I'm trying to get back down to the screen where I can see if we have questions.
Okay, thank you so much, Kelly. I can read out some of the questions for you. But before I jump to that, I want to say that next week update, Dr. Andrew Novakovic from Cornell University will be joining Leonard Posin, and they will be talking about new mandatory dairy processing costs and yield survey. So now back to a question over here. We have, with the One Big Beautiful Bill Act permanently increasing the estate tax exemption to 15 million per person starting in 2026, how should Wisconsin farm families adjust their succession plans to take advantage of this change while still preparing for state-level differences and USDA program payment limits?
That's a great question. Oh, and Jeff, do you want to jump in on that?
No, sorry. I was trying to denote that you would answer the question live.
Got it.
I do
Sorry,
not want to
folks. We can see some different verbiage back and forth depending on what buttons we click. So it looked like Jeff wanted to answer, and I didn't want to stop him, but we'll jump into that one. So couple of things here. The first thing I want to talk about is the question about how should farm families adjust their succession plans. And that is an interesting question just as a standalone, because every farm family is going to be a little bit different. So when we talked about the estate tax exemption, I also talked about three other items that I sort of term the defaults of farm succession, and that's intestate distribution, which is the idea that if you don't decide who's going to get your assets, state law will decide for you. Probate, which is the process for actually cataloging those assets, paying off creditors, and then distributing them. And then long-term care, which, of course, if we don't have a plan, the assumption is that you're going to pay out of pocket for that. So together with estate tax, those are our defaults. If we do nothing, we're going to pass away holding those assets and go through that process. If we're thinking about adjusting the succession plan to take advantage of the change, what we first want to think about is what are we trying to accomplish in the first place, right? What is our ideal final state without even thinking about any of those topics? Who should get what and at what time? Once we know that, we can start building out plans to think about, what tools we want to take advantage of. Now, certainly, if someone is in a situation where they do have an estate that is over that 15 million per person or that 30 million per couple, and they're concerned about a future drop, then they might look at tools like moving those assets into an irrevocable trust today, or gifting them today in order to get them out of their estate and take advantage of that higher increase. Given that this is brand new, and we've got at least another year with our current makeup in the legislature, it's probably not an imminent move that needs to be made. You'll want to keep a finger on the pulse in case there ever is a conversation about dropping that limit, which might encourage you to make that move sooner rather than later. But know that if you are doing that, right, you're moving assets into an irrevocable trust to get further appreciation out of your estate. You're gifting it, again, to get further appreciation out of your estate. Then we're not going to necessarily have the income tax perks like a step up in basis. So we're always sort of weighing back and forth how one option or another will play into it. I do think the state level differences are going to drive a lot of farm succession conversations. I look over at like Minnesota, I believe their exemption is something like $3 million. And so they're in a scenario where farms are much more quickly prompted to start worrying about state level estate tax than what we have here in Wisconsin. For our Wisconsin farms, I think it's going to be really important that we continue to encourage folks to think about what their motivation is. If estate tax isn't a motivation, and it's sort of been the boogeyman in the back of the room for a lot of years, what is going to get them to the table to make sure that that plan is set up so that those other three defaults are addressed, right? There are other consequences out there that folks will probably want to plan for. And then, of course, with USDA program payment limits, we've certainly seen some changes in what those look like coming out of OBBBA as well, that are going to allow entities to be structured a little bit differently without necessarily running afoul of those payment limits as it used to be. So if you do have a plan in place that factors some of those considerations in, it might be a good time to check back with your attorney and see if there are updates that are needed. We always say, every 3 to 5 years is a good time to review those plans. Also at death, divorce, disability, sort of all the D's there. But this is another big item, right? There's been a major structural change. And so you may want to see if your plan is still doing what you need it to do.
Kelly, one question, just kind of linking back to actually to Silva and Paul's talk last week. So it's likely that folks are going to be receiving a decent chunk of supplemental income this year from government payments. How are those handled in taxes? I honestly don't know that myself.
Yeah, great question. I don't want to get it wrong offhand because there are some changes with supplemental disaster payments and how they're going to be taxed. Let me see if I have a slide on that because I thought that I did. Not in this presentation, but elsewhere. I'm not finding it immediately. I do know it's something that Iowa State Center for Ag Law and Taxation has addressed. And I will give a big shout out to them. Christine Tidgren and her team down there do a lot of this work nationally and are really the drivers and sources of a lot of this material. So we can get that information out to folks who are interested, but very much encourage folks to check out the Center for Ag Law and Taxation at Iowa State's website because I know she does address that there.
Sounds good. Thanks. Sorry, I didn't mean to spring that on
No,
you.
that's okay.
I think that will be all for today. We don't have any other question. Thank you so much, Kelly Wilfert, and thank you, Dr. Jeff Hadachek, for that as well. And to you, our attendee, thank you very much for joining us. Hope to see you next week.